As again, Kendall, I appreciate having me on, of course, because this is important and no more important time than right now, because this is something that literally has not just changed my own life, but hundreds of our clients' lives as well. There's a reason why I'm called the anti-financial advisor, which you'll find out because pretty much I'm fighting against financial advisors and the crap they teach, because what they teach you is a set and forget it, set it there forever and save so much that hopefully someday you'll have something. And that method has not truly worked. It's worked for a very small percentage of the population, which we'll talk about. But I want to talk about how do you become work optional. It's actually named after the Work Optional Blueprint book that just became an Amazon bestseller a few months back. I just wrote that, my very first book, and probably my last, because I do not like writing, which is why I have the Money Ripples podcast. So I don't have to do any kind of writing at all because I'm a slow writer. But very proud I got that book out because this work optional blueprint has been proven to work. It's a system that does turn your assets into income. And so today I'm going to cover this is what financial advisors don't want you to know because it will literally cause you to fire them. Also, what moves you should be making now and how can you keep your money safe and invest at the same time? Is it possible to have your cake and eat it too? So just imagine this, guys. Like imagine if your investments were working hard while you can relax with your family. 100% clarity on what you can do. You can be 100% confident knowing that your money's doing what it's supposed to do without worrying about losing it and no longer hoping that your plan works, but actually knowing it will. And that's what we're talking about is how do you become truly work optional in years, not decades? And work optional is simply this. You have enough income coming in from your investments that you work because you want to, not because you have to. How many of you, I'm just curious, I'd love to hear your comments. How many of you guys would love to be in a place where and maybe some of you already are, but you know that you're in a place you are work optional. You work because you want to, not because you have to. Or you can retire whether you want to or not, because you know you have confidence that your income is always going to keep coming in from your investments. That's exactly what we teach. Got some thumbs up. I love that too, right? That's what we really want. And instead of taking 40, 50 years, if the market smiles on you just the right way, no, we want to make sure we can ensure that this happens. And so I'm going to show you how this is done. My inspiration today is really my dad. My dad in this picture, well, actually in this picture, I'm 17 years old, or about the week before I turned 17. You can see based on the picture, this is over 30 years old here. My dad at this point was in his early 50s. Now, I say he's my inspiration for this because my dad was the post-depression era mentality. This guy saved everything. I know because literally I've been going through his house, cleaning out all the stuff he's hoarded, including stuffed animals, because he loved the crane machine. He was a master at it, right? Everything from that to you name it. If it was possible, he could use a spare part, he would use it. Buy everything on sale, case lots. The guy had literally thousands of Christmas decorations because he would always go the day after Christmas to get the sale. This guy was a super penny pinching saver. This is the kind of guy that Dave Ramsey would say, I want to be like Ron Miles when I grow up, right? That's the kind of guy my dad was. And all he taught me to do growing up was to save money. Just save, 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 save. Don't spend it, save it. Well, naturally, eventually, as I went to college, I was going into business consulting and things like that, but I eventually changed direction, became an entrepreneur, and became a financial advisor myself. And after 4 years being a financial advisor, being the typical salesman in a suit, telling you to set and forget it, save it forever, the miracle of the compound interest will work wonders after you're 150 years old, and all this kind of stuff. And hey, don't worry, the stock market's been paying you 12% since 2000 BC. You'll be fine. I was teaching all that kind of crap. And I say crap now, but I believed it hook, line, and sinker before. But then I sat down with my dad. At that time, he was 61 years old. And at 61, he just said, Chris, when are you going to advise me? Because I'm sick and tired of working. He's like, this job, the stress from this will literally kill me. I've already had heart attacks. I've already had strokes. When can I get out of this job that keeps making me work harder, but I'm getting paid less? And so I sat down, looked at all of his numbers. This guy stuffed this 401k like every good boy should, getting the company match. This guy was debt free, where he had paid off everything, including his house, in just 18 years. This guy should have been the poster child, as Dave Ramsey would say, of freedom. However, as I looked at his finances, I said, Dad, if you try to retire today, you're going to need to die in about 5 or 6 years because you'll run out of money. Okay, Chris, that's not what I wanted to hear from you. What do I do? I don't know, Dad. Save more? Work longer? I mean, maybe work till you're 70? Hopefully by then, market won't go down. By the way, this is the end of 2005. A few years later, the market did go down, which is why he did have to keep saving into his 70s. And that's exactly what he did. He finally retired in the mid 2010s when he was pretty much forced in retirement. He got 5 good years of being able to do karaoke, live on a budget, and everything else before all of a sudden he was too sick to even and too injured and everything else to be able to get out of bed. He broke his hips in 2020 and never fully recovered. And so this was my dad's life, is that he was alive, but he wasn't really living. And I realized there was a problem because I wanted my dad to become free. This guy had done everything that I taught as a financial advisor, yet, even though he did everything quote unquote right, it didn't work. It wasn't enough. Even though he was a super saver and he was debt free, everything should have worked and it didn't. A month later, I'm talking with a friend of mine. He said, "Well, Chris, how many of your clients are financially free where they don't worry about money?" I said, "Well, they all worry about money. They all worry about running out of money too soon, that the income won't last." Okay, great job, Chris. How about this? How many of you guys as financial advisors are financially free, not off the commissions earning, but actually doing these investments, putting your money in these mutual funds? And I thought about it. I remember there was guys working in my office since the 1970s. And I said, well, based on what I'm seeing from these guys, nobody can retire off their investments. If they're retiring, it's because they're retiring off their commissions, not off their investments. He said, there's your problem. And I'll give you the long story, very short here. I actually quit being a financial advisor just 3 months later after that conversation. I vowed never to teach about money again, but I did go into real estate investing and doing things in that front where when I was 28, almost 29 years old, I had enough passive income coming in, enough income from my investments that I was able to retire. Now the recession hit soon after that. That was 2006. A couple of years later, I'm broke because I was gambling on my real estate. I was going all offense, no defense. And as a result, I went over $1 million in debt. And especially after starting a brand new business, trying to teach people how to get out of the rat race, just as Robert Kiyosaki teaches. And so I found myself in a pretty big pickle. I was able to dig out of that hole without filing for bankruptcy and eventually pay off that debt and had enough passive income, enough investment passive income coming in again by the end of 2016, by December 2016, which now we're going on, 9 years that we've been able to do that. And this time, I've made it work. This time I kept it off, and I've also helped many other people do the same. And this is what I've learned, guys, is that it's not about how much money you accumulate. Every financial advisor tells you to accumulate money. It's not about that. Cash flow is what creates more options in your life, and more options creates real freedom. That's where it comes in. I can guarantee it doesn't matter how many millions of dollars you have in net worth. If it doesn't generate income, your life feels trapped. You feel the same. You feel like you're still in bondage. And trust me, I've had several people in that very situation. So the question is this, like in the Matrix, do you take the red pill or the blue pill? The blue pill means you go follow your financial advisor, you just keep setting it, forgetting it, and you hope and pray that nothing goes wrong with the stock market, even though we all know it's at all-time highs and it's ready to crash at some point soon. Or you take the red pill and you say, is there something better? But again, the problem is every voice out there, just about every voice, not all of them, but most of the voices out there are all about save more, get rid of debt. You live on the 4%, you retire by 65. And if you just do everything perfect according to plan, like my dad did, it should work, but it doesn't. Because the problem is we have inflation. That's definitely not 2%, no matter what they say. And we all know the truth. We've got other things with tariffs in other countries and Venezuela and Greenland and everything else going on, right? We got national debt hitting all-time highs and that keeps skyrocketing every year. And where are they going to get that money? Hey, why not go after 401ks and IRAs? Because we can change the tax rules whenever we want, right? All these things. And then they tell you live on rice and beans. Just live on a budget. You can do it. You can live tighter. You don't need to enjoy life. Just keep, sipping that front porch, drinking lemonade because it's country time, because it's on sale in bulk and at Costco. And of course, you're sitting on that front porch because you can't afford to drive or fly anywhere. That's what they're telling you to do. By the way, I love Dave Ramsey. I mean, as much good as he's done with teaching people how to live on budgets and get debt free and things like that. Here's the problem. When it comes to investing, this is where it falls apart. For example, here's a tweet he put out. It says, if you save $100 a month invested for 40 years, and what is implied is that 12%, you should have 1.176 million. You do not have to retire broke. He even says everybody should retire a millionaire. Here's the problem when you get advice from financial advisors or financial experts and gurus out there is this. One, If you save $100 a month for at 12% for 40 years, you don't get 1.176 million, you get 979,000. So good job, Dave Ramsey. You can't even do math right. Two, even when people do follow advice, like Michelle 1A here, she says, Dave, I followed you since I was 18 years old. I'm 50. I've lost my entire retirement, my entire, my entire retirement, take out that extra in the stock market. I've done what you said, but I've lost almost all of it. Is there anything else you'd recommend? So after she's already followed his advice, it didn't work. Then she's like, what else can I do? Can you tell me how to lose more money? Right. Here's the other thing. Fidelity statistics from 2023. There was 45 million account holders with IRAs and 401ks with Fidelity, largest one in the country. Of those, 810,000 had a million plus. Now this just got updated. There's now 1.1 million that have $1 million or more at the stock market all-time high. You guys realize that the stock market has been going up 16 of the last 17 years. Since March 2009, we're about to hit literally 17 years in a row where the market's gone up, except for that little blip in 2022 that people have already forgotten about. Do you understand that we've never seen the market do that in history? Well, guess what? Now there's 1.1 million account holders out of 45 million have $1 million plus. Still, that's about 2.5%, guys. 2.5% have $1 million or more out of all the account holders. You'd think there would be more than that. But here's what's kicker. Transamerica did a poll of these same people. 35% said it'll take a miracle to be able to retire. Why? Because the 4% rule is old. It's bogus. It's outdated. If you ever heard the 4% rule, it says if you have $1 million, you should be able to pull off 4% a year. That's 40,000 a year. However, the guy that came up with that in the 1990s was using numbers from 1926 to 1976. These numbers are now 50 years outdated. Also, we've lived longer. We now live longer and inflation's higher because just before 1976, what happened? Nixon took us off the gold standard and inflation started skyrocketing more and more. And by the way, more than what the consumer price index says because the governments are manipulating those numbers to look lower so they have to keep raising Social Security as much. So we got all these things happening, right? That 4% rule is broken. If you're in your 60s, it's a 3% rule, meaning if you have $1 million saved up, you should only be pulling out 30,000 a year so that you don't lose to inflation, taxes, and of course, to market swings. 30,000 a year. This is why over a third will say it'll take a miracle to be able to retire because they did the numbers. Financial advisors are starting to teach a 3% rule, 4% if you're in your 70s, and that's it. By the way, if you're trying to retire young, there's a whole movement out there called FIRE, Financially Independent, Retire Early, saying how can you retire by the time you're 40? It's a 2% rule, not even a 4% rule. So you got to save double that money. So most people have to save into the multi-millions to ensure that they at least can live a middle-class lifestyle. By the way, right now, what's also happening? Buffett's storing record amounts of cash. He's got almost $382 billion stored up. This is 12 straight quarters in a row. He's been selling more stocks than buying. He also sold off Bank of America, which people have been saying buy more of. He also sold off his Vanguard S&P 500 ETF when every financial influencers on social media are telling you buy the S&P 500 index. He's already been selling out by 2024. You guys are already late to the party now. He even sold off Apple stock. By the way, he's gone against the crowd in September 2008 when he actually bought Goldman Sachs when everybody was selling. He bailed out Bank of America in August 2011 when everybody was bailing out on banks. And in fact, Bank of America was literally going out of business. And he dumped the airlines back in 2020 as well. He goes against the grain all the time. And who's the richer? He is, right? You got to think how the wealthy think. They think the opposite of the masses. And right now, the wealthy are selling while the amateurs are buying, especially in the stock market. This is the era of dumb money, as I call it, where more people, the average Americans, throw money in the market thinking they'll never lose. It'll always go up, right? Even in mutual funds right now, this is scary. Mutual funds have almost no cash left in their portfolios. What does it mean if the big financial institutions, the Merrill Lynches, the Goldman Sachs, the Fidelities, what if they don't have any more cash to invest? Guess what? That means not more money is going to the market. And that means if you've got money in the market, it might be the very time you start to watch your money deplete. When you get to the era of dumb money, this is when average Americans, the retail investor puts money in, but institutions are selling and pulling it out. Right now, the market's already way overvalued, over 230% higher than the GDP should be. So that means really we're about double. The stock market's more than double where it should be to be back to normal. You don't think there's going to be a correction down the line? Come on. Even even right here, this is Vanguard. They had their forecast. They believe that in the next 10 years, the stock market will average between 2.8 and 4.8% for the next 10 years. That's average per year. Guys, they're basically saying a CD will probably return you just as much, a safe CD will return you just as much as a stock market because they expect major corrections too to offset this. And you got to ask yourself, which phase are we in? Are we just taking off the stock market? Are we in the delusion or greed? Are we in denial? Return to normal? Are we about to see something go down? I'll leave that up to you guys. But if for a guy who not only was a financial advisor that told you to buy lots of mutual funds, I also used to be a stock trader. And I'll tell you, not just from my experience as a stock trader and seeing what's going on in the stock market right now, but also from my friends that are stock traders, you know what they're all saying? It's stupid to be in the stock market right now. But where does every financial advisor tell you to be? And in fact, where do they tell you to be when the market goes up? Stay in stocks. When the market goes down, what they tell you to do? Buy more stocks, right? Because it's on sale. You got a dollar cost average, right? Don't pull that money out. Keep putting it in while they get paid whether you make money or not. Tell me how that's ethically, it might be legal, but is that really ethically correct? That somebody gets paid even when you lose money in the stock market? Who's taking the real risk here? Financial institutions? No, they don't invest their own money in this. They make you do it. This is the problem that I'm seeing today. Stop playing their stupid game, right? It's not about that. It's about really taking control. And this is where this work optional blueprint comes into play. And this is the blueprint they'll never show you because one, they don't know how to do it themselves because they haven't figured out how to become financially free. That's why they keep working as financial advisors, hoping their commissions will keep them and help create freedom for them instead, not their investments. But also, most of them don't even know how to do it, right? That's the problem. And they don't want you to know. Now, this is right out of my book, straight out of my book. Here's the 5 phases, which we'll go over here today. Everything from laying the foundation for financial freedom, selecting the right investments, taking action, protecting your assets, and then multiplying your passive income, which I love. I call it the income avalanche, right? Now, if you're to dumb it down, this is pretty much what I teach in 3 phases. You got to get lean, get liquid, and get out. Get lean, get liquid, get out. You remember nothing else. This is pretty much it if you were to dumb it down into its simplest form. Get lean means we get rid of money leaks. Are you overpaying on taxes, right? I know that also ties in very closely with asset protection and what kind of corporations and entities do you have and things of that nature. Are you losing money on unnecessary loans or debt? Are you spending money in areas you didn't even realize you're spending money in? Are you contributing to crappy things like 401ks, which don't work? Which, by the way, 401ks, Fidelity, their performance is so bad that even if you get a 100% match, it barely makes up for their bad performance and excessive fees. You would actually be just as well off investing on your own than getting a 100% match of a 401k. I took that slide out of this presentation because, again, I didn't want to make this 5 hours long. But again, my book definitely covers that too. But yeah, get lean is just make sure we get rid of those money leaks and shift money to be liquid next. How do we make sure your money's liquid and available? You can get to it. Don't lock your money up in prison, 401ks, IRAs, and whatnot. Don't get your money locked up there. Don't lock up all your money in home equity because when you need it the most, that's when the banks never want to give it back to you. And if you need it too, often it's because the rest of the market needs it and then you sell it for a bad price. So again, keep your money liquid in your control and then you can get it out into cash flowing, predictable passive investments. So phase 1, laying the foundation for freedom. What does that look like? What we do is we do a cash recovery audit. We look at those things. You can do this yourself. If you're tracking your money, whether you're using Rocket Money or Monarch Money, start tracking your income and expenses. I would do it weekly and see where your money is going. How much is coming in? How much is going out? Really look at that. Also look at your net worth. Net worth is worth less. Net worth is worth less than income. It's not worthless, but it's worth less because you want net worth to actually pay you. But unfortunately, in that accumulation theory that every financial advisor goes by, they don't tell you to make income off that net worth. They're telling you to just set and forget it, compound it forever, and then hopefully you'll pull off less than the interest. Why? Because that means they get paid forever. Because if you never run out of money, one, you don't stay scared, you'll just live cheap. But in the meantime, they get paid their fees, whether, no matter what, right? That's again, another thing you got to be aware of. You want to design your freedom strategy. Get liquid. Where are places you can get liquid? Bank savings, Do we have money there? Can we use that money more productively to be able to generate passive income? Life insurance cash value. We'll talk about that a little bit. Most people don't realize that if they have things like universal life or whole life, they can actually tap into a tax-free savings account that they could use to actually invest and make better returns than they're making in their life insurance. Three, mutual funds. You have naked mutual funds or stocks, bonds, things like that. Old 401ks, IRAs, not a current company 401k because it's locked up. Unless you're over the age of 60, there might be a way to access it through in-service distributions. But old IRAs and 401ks could be using that. Roth IRAs, rental properties. I see so often people have a low, even though they get paid income from the properties, they have a low, what's called return on equity, where if you take the total equity in their property and divide their annual cash flow, their annual profits into that equity, you'll find out they're not making a whole lot of money. I had one client in California who actually had 800,000 of equity in his property, and he was making $200 a month. I told him, I said, buddy, that's a 0.3% return on your equity. You could literally sell the property, put it in a CD, and make more money than you would keeping this rental. 2 years later, he finally said, all right, I'll do it. Cashed it out, sold off that property, went and invested it, did a tax-free exchange called a 1031 exchange into 6 properties in Louisiana. Those properties start kicking off income. He started buying more. He just updated me. He says, Chris, I just went to over 100,000 a year of net profits on my rental properties now. Over 100,000 a year from $200 a month. This is just in 5 years, guys. Spoiler alert, that's one way you can actually do it. Your own home equity in your own house. That's another one too. Gold, silver, crypto, especially Bitcoin. Oh my goodness. I see so many people saying, I got to hold on to that Bitcoin. Well, how much income is it paying you? Nothing. Could we do something with it? Silver. I mean, I've got 2 of these things. I bought these things in September for $42 an ounce, and now they're worth about $85 an ounce. Okay. Now, this is great. I like to keep this as protection, right? As part of my asset protection and diversifying my assets. But guess what, guys? Still, if you have only assets like this, but no income, get rid of these, start generating income from it. Now, everybody will say, okay, Chris, you seem to hate on 401ks. Where else could I put my money? Because here's the thing, if I cash out these things, I'm not making money. I don't have that offense working for me, right? Because your cash should be an asset, not a liability. It should be sitting around the bank making 0.nothing%, plus you get taxed on 0.nothing%. You lose to inflation if you do that. But if you don't try to lose to inflation, you try to invest it. But then if you invest it, what if you have high risk investments you're putting it in? Now your cash is not safe anymore, right? How do you get that right balance so that, I guess I just skipped a little bit, my internet. So sum up here, if you missed part of that, how do you balance between the growth and safety at the same time? I like what Coach Bear Bryant says. He says, offense sells tickets, but defense wins championship. Nobody would have ever heard of the quarterback Tom Brady had Tom Brady not had a good offensive line to protect him. That's the truth. If a quarterback doesn't have a good offensive line, they can't shine. And I just made that rhyme. And that just sounded like a rhyme. Anyways, I'm not trying to rhyme here, but it's true. If he didn't have a good offensive line, he wouldn't have been able to shine. And that's key for you too. You need to have a good offense and defense, this 1-2 punch, to make sure it works. Interesting study. In 2021, initially, Ernst & Young did a study that said, what's this magic formula of assets? Like, where do we make sure that we have lifetime income? And even as a bonus, could we even make sure that it passes on assets to the next generation if we wanted to? Here's the magic formula. 60% in low risk income assets, like fixed income type of assets. 40% in high yielding investments. You know how you hear people say all the time, do the 60-40 split, 60 in stocks, 40% in bonds? They said that doesn't work. They said, in fact, bonds don't do any good because they're not safe either, because often bonds will go down when stocks do too. So they actually said, no, low risk type investments, combining, ironically enough, insurance of all things, plus doing investments. So in using insurance as the defense, investments as the offense. Now, what's a Swiss Army knife of savings? How could you get everything in where you could have it liquid? You can use it for whatever you want, whenever you want, but no one else can get to it. Lawsuits, creditors, no one can get to it. Speaking of asset protection, the returns are better than inflation. Ideally, be tax-free. Pretty much you already described my perfect savings account, maybe yours too. Safe from bank failures and market crashes. And even better, your family inherits more than it's worth tax-free. Does that even exist? Yes, in the US it does. And it's the most boring thing you might ever think of. It's called whole life insurance. But we're not talking about traditional whole life insurance. That's the problem. Even that study, Ernst& Young did a traditional whole life insurance plan that they're comparing. No, no, you don't even want to do that. So we're not even talking about traditional infinite banking. If you ever, I don't know if you guys ever heard of this book before. Feel free to put it in the comments if you have. Becoming Your Own Banker by Nelson Nash. Great book to read. But we're not even talking about that because there's some things in that book I disagree with coming from an investor perspective. What I'm talking about, this is referred to as what we trademarked as max ROI infinite banking using whole life insurance as this. Now, here's the difference. You have a traditional savings account, right? It's savings that sits there and makes nothing, right? Very low ROI. You're lucky to get over 1%. Maybe a high yield savings account, you might get a little bit, maybe 3.5% right now. No protection. Did you know that if you have a savings account and you get sued, your money's not protected in that savings account? They can get to it and put a lien against it or just take it out, whatever they want. That's a big risk. So if somebody sues you or there's creditors, they can get to that money. Also, there's no leverage, really no opportunity either. I mean, basically all you have is you have to get that money out to invest. But with whole life insurance, if it's designed just the right way, not the way that 99% of insurance agents will do it, do not trust your Jake at State Farm with his polo shirt. He will not give you the right thing. This is something where if it's done right, you can get 6% or better tax-free rate of return on that money. In most states, 100% protected from lawsuits, creditors, fully protected. Meaning you have millions of dollars here. Someone sues you and wins, they cannot get to it. And I've had clients where that's actually been true. Definitely a better ROI than you can get than a savings account. You can also get some great bank leverage I'll talk about, and there's big opportunity to be able to make money in two places at the same time. This is literally a tax-free, high-yield savings account. As I try to put it there, I mean, again, get the highlights: tax-free, 6% a year, protected from losses, creditors, and guaranteed to grow. No market risk, by the way. By the way, the wealthy have used this for decades. You guys know Walt Disney? Did you know that Disneyland came to be because, well, one, Walt was a dreamer. And the problem is his dreams were bigger than his pocketbooks. And he was trying to build this amusement park that didn't have alcohol, which back in those days was considered to be a myth, right? It was a dream. But he wanted something that was family friendly. Well, NBC, CBS, they turned him down. But a new and upcoming station, ABC, said, listen, Walt, if you can come in with some of your own funds, we'll come in with the rest. We'll finance the rest. Well, guess what? He sold off of his vacation home and he leveraged his whole life insurance, not the death benefit, but the tax-free savings account inside of it. He leveraged that cash as collateral to get the rest from ABC, and the rest is history. Now you stand in line for an hour and a half waiting for that stinking, ride that everybody smiles about, right? That's how you get the happiest place on earth. J.C. Penney's during the Great Depression actually paid his payroll when he couldn't meet it. When the company was out of money, he used his life insurance cash, the savings account, to pay his payroll to keep the company afloat. It's not just these guys, though. It's still being used to this day. Jim Harbaugh. If you got some of you guys who are football fans, Jim Harbaugh was a coach of Michigan. He's now the San Diego Chargers. But in 2016, he actually got Michigan as part of his package deal for his pay. He got them to loan him $2 million a year plus $4 million up front to go into his life insurance policy. Loaned him. Just so you know, how much do you get taxed on loans? You don't. I'm not talking about, taxes, property taxes, right? But when you get a loan, like a mortgage, it's not like you get taxed as income tax, do you? Same thing. He was loaned the money from Michigan. Now, he could access that cash whenever he wanted, but he did have to keep the money they loaned him available and liquid inside that account. But remember, it's growing tax-free, protected from losses to creditors, and he's able to earn, essentially, compounding interest on money that he's essentially getting a 0% loan on. So what happened is he was now making money off their money. And of course, because when you put it in life insurance, it has the same tax rules as a Roth IRA. After tax dollars go in, or in this case, money was loaned to him to go in, it grows tax-free, comes out tax-free. So now he's creating literally an infinite rate of return on his income that was tax-free now. And then, of course, he can pull out that money he just made tax-free, right? So it's not just him. I've had other people on my show, my Money Ripples podcast, a guy that's a private, equity investor. He's literally bought and sold companies for hundreds of millions of dollars. He learned the same strategy from his grandfather who owned a bank. Do you know that often the families that own banks won't even put money in their own bank? They will instead put their money here. So this is the problem. All the wealthy have known this, but they've taught the middle class, no, you should just throw your money in that $6,000 or $7,000 a year into your Roth IRA. So then you get some tax advantages. It's the broke person's version of tax-free investing, but the rich people don't do that. Even the middle to upper class have started to learn about this more and more, and it is available to even the middle class to do something just like this. Now, this isn't for everyone. For example, because it's life insurance, it is based on your health. So if you're in poor health, maybe you're battling cancer right now, or you just had a heart attack, you probably won't be able to get this insurance. Also, if you're over the age of 70, you could probably get this insurance, but it's going to be pretty expensive. You may not be using this to invest right now. You'd be using it for more asset protection instead. Also, if you're paycheck to paycheck, if you don't have, in my opinion, if you don't have at least $5,000 a year, roughly $400 or $500 a month that you could be saving right now, I wouldn't do this strategy because I would just buy term insurance, cheap term insurance to cover your family's needs, and that's it. But if you got at least a little bit of money to put away into savings and you want it liquid and you want to be able to use it to invest wherever you want. And even if you're not in great health, guess what? There might be an answer there too. I had a client who was very overweight. He was in his mid 50s. He said, Chris, I'm pretty sure even if I get approved, it's going to be expensive. Could I do this on my wife? I said, sure. Tell me about her. Well, she's 52, great health. She goes to the gym every day. And yeah, she's great. And I said, well, one, she's a woman. Women live longer. They're already automatically cheaper. Two, if she's young and healthy, maybe we use her instead. So what did he do? He started funneling $105,000 a year into his plan, under his wife's name. He had the control of the money. And guess what? When he did get sued, guess where was the one place that people could not get to? You got it right there in their life insurance plan. And so big thing for asset protection, that alone, I've had real estate investors, even big ones, say, wait a minute, even if you got rid of the whole rate of return, the fact I can keep my assets protected, that alone is worth it. So, but again, it just depends. So like I said, even if you may not be able to qualify for insurance, maybe you've got a spouse, children, grandchildren, people like that could be doing this kind of plan that gives them the money, gives them a leg up to use this money to invest however they want. And that's what we mean about selling tickets. We can still do offense, but play defense as well, because again, guaranteed no market risk. Now I'll tell you, when I first heard about this, I thought it was bull because as a financial advisor, remember, I was the one telling people to buy mutual funds. And then when somebody tells me, especially real estate investors saying, yeah, you should get whole life insurance. I was like, come on, what? Whole life insurance? That's the worst thing in the world. I didn't know that for a fact. That's just what I was taught by every other financial advisor to say. I thought they didn't pay anything. Well, I eventually started to understand more about it. I read that Nelson Nash book. Eventually I went to an insurance agent and said, hey, even though I have an insurance license, can you set one of these up for me? When I first saw it, I have to admit, guys, I was like, wow, this is kind of expensive. Could we pull some levers here to make this better? The agent told me, no, if you do that, you'll trigger taxes. I said, well, I don't want to pay taxes, so let's just do it your way. This is in 2006. 2 years later, as I mentioned, 2008 is rolling around. I'm in the whole $15,000 a month. I'm quickly sinking into debt. I can't keep affording to pay $1,000 a month into this program. And so after paying $25,000, I called up the insurance company and said, hey, can I stop paying premiums for a bit until I get myself back on my feet? They said, no, if you do, the policy cancels. So long story short, policy canceled. Just months later, I'm talking with another friend of mine and found out that I could have actually had the agent pull different levers, just like I asked him to do, but he told me he couldn't. He actually could have. I found out he lied to me. So what did I do? I used my insurance license because I still had it active. I went and ran my own numbers, did my own research, showed him I could have had cash in there from day one. Because the thing is, I was paying all of these insurance costs and fees, and that's why there's no money to allow me to go through the recession. I told this guy, I said, listen, if I would have had cash in here from day one, and if we would have structured it a certain way, even if I stopped making payments, it would have been able to pay for itself even by that third year. And finally, after we debated back and forth for a few hours, that agent just told me, he says, Chris, I did it that way because I couldn't afford to cut my commissions. I said, now you're finally being honest with me, and I hate you. Okay, I didn't say I hate you, but I did say I'm no longer referring any of my friends or family to you again because I'd already referred him dozens of people to talk to him, thinking that he was the bee's knees, so to speak, right? And he wasn't. And so from that point onward, I started looking for better ways from more an investor perspective. How can I get the best bang for my buck out of this thing? How can I lower those costs as low as I can go while keeping it tax free so that that cash account grows faster? And that's what we've been perfecting and even brought it in-house in 2017. Because again, I couldn't find insurance agents that were willing to cut their commissions enough to make this work. Guys, the truth is that we cut the traditional commissions by roughly 80% of what they would normally be. So, I mean, that's like a fifth of what we would normally get paid if we just did a traditional plan like you get from your Northwestern agent or a lot of the other agents out there. I'll show you an example. This is with the same exact company. An insurance agent came to me and says, hey, this woman sent me this illustration, this vanilla whole life on the left. She's paying in $60,000 a year. I know you work with this company. Can you do better? And I said, I can already tell you we can destroy this thing because she is overpaying to the max. Because she got a policy just like the one I bought in 2006. Notice year one, she already paid it in, right? There's 60,000 a year on the left right there. Notice by year two, she'll pay in the second 60,000, it's 120,000. That cash value, that yellow column on the right, is still zero. That means all 120,000 that she paid over 2 years is going to pay in the insurance costs, which of course pays the insurance agent. They get paid a percentage of the insurance costs. By year three, they paid 180,000. She finally has $30,000. It wasn't until about year 13 that whatever she paid in, she now has as much as in cash as what she paid in. Took 13 years. The one on the right is the one that I said, here's what we would have actually done in the same situation. And actually, even based on her today, I said, what would happen? Right there, 60,000, she would have $50,000 from day one, not zero. Even year two, 106,000, not zero. Year three, not 30,000, 168,000. That means we're literally saving her $138,000 of costs. Notice by year five, she has more in cash than what she paid in. This is what we mean by max ROI, infinite banking. Now, yes, there's always upfront costs. Whole life insurance, different from term insurance, which gets more expensive over time, or universal life, which gets more expensive over time. Whole life starts out with the higher cost up front, gets cheaper over time. This is why even after 25 years, she's got $3 million versus the 2.3 million she would have had with the other one. Same company, designed differently. The other agent, by the way, she asked for this. The other agent didn't know how to do it because the insurance companies won't teach you how to manipulate the system. That's the problem, right? So again, that she literally was cost herself hundreds of thousands of dollars because of that reason. By the way, I just said this. If you couldn't see the numbers, broke it down. Basically, again, a lot more cash, a lot faster. Here's another one. Normal infinite banking policy was just doing 10,000 a year, not 60,000. This was a 33-year-old man. He was actually the brother of one of my friends who thought he was getting the best deal. And he was so proud of it that he found this guy on social media. And this guy had to be the best because he was one of the authorities on infinite banking out there. Well, he was happy for the fact that he knew that in year one, his 10,000 would then give him about $7,000, 6,900 bucks. He was very proud of that. He also proud that he'd finally break even by year 10 and have 103,000 after paying in 100 grand. Guess what? I showed him first year, you would have $1,000 more. He would have almost $8,000 day one from paying in that 10,000, not 7,000, 8,000. By year 5, he had about the same as what he paid in, way more even by year 10. And of course, his minimum required premium was way lower. He only had to pay in 1,800 bucks a year, but he had the ability to contribute 10,000 a year, right? So again, same thing, broke even in year 9 with that other one. Ours, year 5, he had more than what he paid in by that point. That's a massive difference right there. I even showed that he had about 60,000 more in cash by year 25, but he paid 15,000 less because the premiums were less, right? Another one right here. This one I just showed somebody who's 48 years old, like my age, putting in 30,000 a year for 20 years. Guess what? They can pull out 63,000 a year tax free for the next 25 years. I just realized apparently I skipped there. Again, this one's 30,000 a year for 20 years for a healthy 48-year-old like myself. That's 600,000 paid in, but you can pull out $63,000 a year tax free. And this again, no risk. These have a lot more certainties than other things. Now, I know I'm focusing on this because if you remember nothing else, if you're looking to get liquid with your cash and a good, safe place to put it, everybody's telling you to go offense. Everybody's telling you to go make lots of money in other places. And I'm all for that. I'm all about making massive money like I do in real estate. But this is the thing that I've been doing the last couple of years, just like Warren Buffett, is getting liquid with my cash, getting it freed up and making it better. By the way, I'll give you one more example. You can even scan the QR code if you want to see the actual interview on my podcast there. This couple, they're in their mid 50s. They were doing infinite banking already. And they asked me, they said, "Hey, Chris, can you analyze what we have and see if we have something that's good or not?" And I told them, I said, "I'm pretty sure it is. You've had it for like 6 or 7 years. You're probably fine at this point, even if it wasn't set up perfectly in the beginning." They said, "Well, can you check anyways?" And so I did. I did an apples to apples comparison of what I could do with their money by you can actually tax-free exchange your money that might be sitting in current policies to a new one. So I showed them, what if they move that money over into a new policy with us with this max ROI method? And you know what happened? 20 years. Now they're paying 150,000 a year between the two of them, but in 20 years they'd have $2.25 million more in that tax-free savings account than staying with their plan that they had with their quote unquote infinite banking advisor. 2.25 million more. And they would have $4 million more death benefit too to protect their family. That's the big difference. That shocked me and it shocked them. And needless to say, we moved that money over. Now, some people are really getting popular talking about indexed universal life. Even when you hear infinite banking, you're hearing IUL mentioned. Indexed universal life is basically, if you haven't heard of it before, it is permanent insurance, but it's like term insurance that renews every year. That also has this tax-free savings account. Problem is this, is one, you can't double dip your money, meaning you can make money in two places at once. Two, costs go up every year. And three, there's no certainty because if markets go down, these things don't perform well. You could actually lose money. And so I'm going to skip past this. I'm going to move into how do you use it, and then how do we move into these other phases of using this with investments. One, you can use this money as collateral. I literally had a client who was going to get a building loan. He was just going to go get a typical mortgage with some build out on it. And then he said, "Well, Chris, I could get a loan, but what if I just cash out this life insurance policy I have over here with 300,000 in it?" He wanted a loan for 375,000. I said, "Well, before you do that, you could cash that out and then just have little to no loan. Or maybe we can see if the bank will use that money as extra collateral, just like Walt Disney did." So we did. Went to the bank. They said, "Oh yeah, if you've got that as collateral plus the building, we'll lower your rate from, it was over 6% down to 3.75%. So his payment, including the build out, was just $1,800 a month. Over that year and a half, he built it out, got a renter to pay his mortgage for him. So he was now working his own practice in there, mortgage free, essentially, because he had the renters paying it off for him. And then a year and a half later, he said, "Hey, listen, is there enough value in this property that we can actually take the lien off my life insurance?" And they said, yes. So they did. So you can use this as collateral. This is literally how people are using it all the time. You can use it for emergency fund or business reserves. I keep the lion's share of my reserves in this account because one, it is tax-free. It's nice to not have one tax form, especially this time of year. And then two, it's going to make a lot more than 0.nothing% in the bank. So for example, if I have 400,000 sitting in total cash, what if I have 300,000 that's just sitting in here, which by the way, this is true. 300,000 here making 6% a year, that's making me 18,000 a year tax-free versus that 300,000 making literally 0.05% in my bank right now. That means I'm only making about $150 a year, and then I get taxed on $150 a year. So massive difference. Kids savings. I'm seeing more and more people stop their 529 college savings plans, and definitely not their Trump accounts, as they've been trying to sell us on recently, where you can actually have more freedom to use the kid accounts for more things. And you don't have to use it for college. It can be used for anything that you want them to, but you control it. You get to keep the controls and the reins on it, but later you could gift it to them if you chose to or not. We also have people getting extra retirement income. I'll talk about that in a bit. And then of course, cash flowing investments. You can literally use this money to make money in two places at once. How? You can pull money out. You can withdraw from this tax-free savings account, but the better option is you can borrow against this life insurance. You can get a collateralized line of credit, whether through the insurance company or certain banks that specialize in these kind of loans, where you can actually borrow the money from them using your cash as collateral. So say you have 100,000 sitting in cash, instead of withdrawing 50,000 to go and invest it, instead you borrow 50,000 from them. Yes, they charge you interest, But the good news is this, is you could pay back the loan, however, whenever you want. Your deadline to pay it back is your death, which they just take out of the death benefit and pay the rest of your family tax free. And so the reason they were able to do this is for this reason. They're paying you on that full 100,000. Say they're paying you 6% on $100,000. They're paying you $6,000 a year. But if you have that 50,000, say that the loan is still the same 6%, let's just say, for example. Well, now that 50,000 is being charged 3,000 a year. They know it's growing still by a net $3,000 a year. You're making extra money on it. Even better though, is if you do something like this. If you use it for cash flowing investments, like we talk about in this system for becoming work optional, then this thing starts to work as a well-oiled machine where they work together. All the parts and the components work together. That's how you create acceleration. For example, say you have a fourplex that's $1 million. You put $250,000 down payment. Let's just say the cash flow after all expenses is $2,500 a month. Most people would just cash out of their savings account, put the down payment, and then use the cash flow to rebuild their savings again. But remember, you're not earning much interest. Well, what does that interest look like? That $2,500 a month over 9 years? How much interest do you actually earn in a 0.1% savings account? $1,200 after you pay taxes. A whopping $1,200. Now, using that same strategy, using life insurance, again, using that money as collateral to get a line of credit against it because the interest rate's so favorable on the insurance side versus using your own bank account. If you do that instead, even after you pay the interest costs to the bank, but because you start paying down the loan with simple interest, but they're paying you compounding interest, watch what happens. You net $126,000. Definitely better than $1,200, right? That's $126,000. Now that's based on mine in my mid 40s. It'd be more or less depending on you're younger or older. Either way, it's pretty easy to beat $1,200. That is the difference. You earn more interest dollars along the way. And notice it doesn't just sit there in life insurance forever. No, you can literally use that money to invest in other things. I have clients using it, actually investing with Troy Eckert, who does the oil and gas stuff, the mineral rights, does stuff with that, does this with lending, real estate lending, does this with syndications, does this with rentals and everything else. This is how you make money twice, because what happens is that the compounding interest they pay you is more than the simple interest you pay them. Because as you pay that loan down, interest goes down, but their compounding interest goes up. You literally make a profit spread off of that, and you're still making money on that property. You can literally have your cake and eat it too. It's like the Jerry Seinfeld double dip, right? Instead of double dipping that chip, you double dip on the money. So that's how you do it. And you do that cycle again and again and again. I show people all the time, it still trumps anything you do in a savings account. Best way to fund it is this. I like to use my emergency fund. I put that money in there first. I don't invest it right away. Get my money there so I can actually earn better returns on my savings accounts of money that's not going to be invested anyways. After 3 or 4 years, then I start using it to invest. That's how I will use it. And there's a whole other reason behind that I won't get into. Here's the overall perspective, right? Is that as we improve cash flow, we shift that perspective and start focusing on cash flow, not accumulation. We get liquid money through the infinite banking system to then go into passive investments to then build up the cash flow again and again and again, picking up and compounding money. Now, yes, as we move into phase 2, right? I know that phase 1 was a long one, but that's the biggest one of all the phases we do when we coach people. Phase 2 is now we select the right investments. How do we know? What are the wealthy investing in right now? Which ones fit your freedom plan? How do we do it with you and things like that? A big question you should be asking yourself is, do I need immediate income, or am I okay having some growth on this money? Depending on how you answer this will depend on what investments you pick. For example, I've seen people just willy-nilly investing all over the place like they're throwing spaghetti on a wall. However, I've had people that say, well, honestly, I want income right now. Okay, well, why'd you put your money in that investment, which won't pay you for another 5, 6, 7 years? And that's assuming it goes well. Instead, we could have used that money to go and invest here where we can start getting an immediate return right now instead of waiting for it. Others will say, honestly, I don't need the income right now. Let's put it away. Let's let it grow. Great. Here's some other investments that might work better, right? It's kind of hard to see this with the words, but I'll explain. Like turnkey rentals, mention that. That's a cash flowing and a growth investment. Right now, the cash flow is not great. Turnkey rentals are when you have a property manager on properties. And turnkey companies will actually help you find the property. They'll help you finance it. They'll help you get renters in it. They'll do everything for you. You just have to buy it and manage, and you don't manage it. They do. That's one thing that's great about them. Now, of course, depending on current market conditions, turnkey rentals aren't great. One of my favorites right now, though, is the second one, which is lending. I'll tell you, like I've actually used lending and I've even used it with infinite banking. I had a guy that was paying me 15% a year on my money. And I said, all right, cool. Let me use my whole life insurance. I borrowed from that, wired the money over to him because I took that money from my life insurance, put it into my bank account to wire over to him at that point. And 3 months later, I got paid back my principal plus, roughly about 3 or almost 4% interest that I got back too. Hardly any money was even charged to me in interest on the loan. And I got all the interest back, paid it back into my policy, was able to do it again. Lending can be great. Usually 10 to 12% is pretty typical per year. This means, guys, if you've got, $100,000, that can generate anywhere from about $800 to $1,000 a month in those kind of things. There's funds and various types of funds that could be invested in different things, maybe more diversified in certain areas. Could be into commercial buildings. It could be into lending, but now lending to many people. It could be apartment buildings and syndications, self-storage units, oil and mineral rights, like I already mentioned, right? Partnerships. I got a raw land partnership where I literally just finance it. They do all the work. I'm a 70% partner, but we're kicking off over $12,000 a month right now with just about $500,000 invested over the last 4 years. Guys, that's huge, right? And so lots of options that are out there that, again, Wall Street and financial advisors will never tell you about because either they don't want you to know about it because they don't make money on it or because they don't know about it themselves. Phase 3, of course, is once you start to look for the right investments, then you take action on that plan. You've got to start taking action and investing that money. 4, you got to make sure you protect your assets, which we talk about all the time, especially with Protect Wealth. That's literally what they talk about is protect your assets, having the right corporate structures and entities in place, having your wills and trusts and everything done. How do you make sure you have the right insurances for any aspect of life so that one event doesn't wipe out all of your wealth that you worked so dang hard for? And then the 5th one, which is, of course, one of my favorite, of course, minimizing taxes is a big one too. The 5th one is multiplying your income. As you start to find those investments that are working, you can double down. You can start reinvesting some more and doing that. You take the cash flow you're earning, reinvest that so you don't compound interest, you compound income. Because if you're able to generate, say, $50,000 a year of passive income, guess what? The next year that $50,000 can be invested, maybe it generates another $5,000. Now you're up to $55,000. Next year, you reinvest that. Now you're about $61,000. You do it again, you're at $67,000. And then you compound that passive income to the point where you become work optional. And so again, that whole system, you see another infographic like this. You can also use this with opening a policy. Now, again, you don't need the policy to become financially independent. It just throws a little extra gasoline on the fire. It just allows you to be able to build up more, especially if you got at least 5 or 10 years before you hit financial freedom yourself. Now, if you're already at the point you say, hey, I don't have 5 or 10 years, there's another option that you can do. Just so you know, lots of people use it. Real estate investors. I've had other people, like this was a dentist couple. They said their only regret, they didn't do it 20 years earlier, this kind of strategy. This guy, actually, Dan Markert, was on my podcast twice. He literally had $1 million as his retirement plan. His financial advisor says, good. Now he could live on $30,000 a year. He found our podcast and worked with us on finding different investments. He bought duplexes. He got into some apartment syndications, and then he even got into some mineral rights as well. And later that next year, just 6 months later, instead of $30,000 a year, he had over $130,000 a year coming in. Some of that with tax advantages too. So there's, again, just huge ways to do this. So again, and of course, we don't even talk about generational wealth and everything else. Let me give you a few examples here, and then we'll open up for questions or anything else, because I know we're pretty much out of time at this point. But here's one right here. This guy was 59 years old. I just talked to him a few months ago. His goal was he wanted about $200,000 a year, 15 to 20,000 per month. It was his passive income goal that he wanted. Not even become work optional. That would be a beyond work optional for him. But he wanted about $200,000 a year. Here's the thing. He had 1.9 million in retirement accounts. Plus he had a couple of rental properties that had about 800,000 of equity in them. Not the same guy, by the way, not the same one as I mentioned earlier. But again, he's only getting $300 a month from his property. This guy literally says, he's like, Chris, I'm really worth $3 million, but I feel broke because all I have is $300 a month coming in. I don't even know. In fact, I even asked my Vanguard advisor, I said, when can I retire? He wouldn't give me an answer. And I told him, I said, here's the reason. I'm like, you could maybe assume that maybe he doesn't know, but if I were a financial advisor, again, buying into the same traditional stuff that I used to, here's what I would tell you. If you want $200,000 a year and you're going into your 60s, you can only live on 3% a year. That means we got to have 33 times the amount that you want to live on per year. So if you want 200,000 a year, times that by 33, that's $6.6 million. Now, if we want to round it up because we know we got to pay taxes, you're not even going to be living on 200,000 a year. That means you got to have about $7 million instead of 1.9 million. We got to more than triple your money to get you to that goal. I was like, that's why your Vanguard advisor won't tell you anything besides keep saving, because he knows that if you were to tell you, you got to triple your money, it will depress you. You know what this guy said? This client said, he says, Chris, I don't mind working until I'm 70. I just don't want to feel like I have to do it. I don't want to feel like I'm required to do it. If I want to work until I'm 70, I want to do it on my terms, knowing that if I want to quit at any point, I could do that. I said, that's exactly what work optional means. I said, oh, and by the way, guess what? Here's what you can do. Move your retirement accounts into a self-directed IRA. You can even cash out some of your retirement if you wanted, but let's just say we didn't. Say you have your 1.9 million and we only made 10%. By the way, most of the investments that we have connections to usually earn at least 10% a year. Sometimes even bordering 12+% a year. So I say, if you even earn 10% on 1.9 million, what is that? 190,000 a year. Bingo. By the way, what's your goal? 200,000 a year. Right. I was like, but you got that rental. But what if we actually had that rental, we sold it and redirected that equity and say, that 700,000, that's left after you paid fees and everything from selling the property. Say that 700,000 now earns 10%. What does that add? 70,000 a year. So guess what? That means you're now at $260,000 a year, or just over 20,000 a month. I said, would that be better? He's like, yes. I said, well, good. Now you don't have to wait till you're 70. You could literally do it by the time you're 60. This other person, now this person's in their early 40s. They had a $15,000 a month goal. They had 1.1 million sitting in savings plus 600,000 in a retirement account. This is another person I talked to just within the last few months. Same problem, right? If you want to try to retire in your early 40s, you got to live on 2%. Well, 2% on 1.7 million, if you combine those two together, is only going to still put you at it's not bad. But living on 2%, what is that? Actually, that's not, oh yeah, $8,500 a year. I had to do the math in my head. $8,500 a year. Nothing awesome there, right? Here's what I told them to do. I say, well, we could move that IRA also into a self-directed IRA where you can invest it and choose how you want. Even if it's just 1 million invested at 10%, that's 100,000 a year. Plus, you still have the IRA money. So the million just sitting in savings doing nothing. What if we could invest it? Bingo, right? Mark, I'm glad you have that question. I'm going to get to that here pretty quick. So keep that hand up. Here's how that compounding income works. That 100,000 year one, because remember, they want to get to 15,000 a month. 100,000 year one, reinvest that money. 112,000 next year, 125, see how it compounds. By year 7, 188,000. Before they're 50, they would have over almost 200,000 a year of passive income, even at a conservative level of return. This type of person, early 50s. Here's what's fun. They came to me, they had 5 million sitting in Meta and Google stocks and things like that. They just wanted to buy real estate to diversify. Before we even had them look at investing, we said, let's free up the cash flow. Let's make sure we find some money leaks. We found we can consolidate some of their loans, do a cash out refinance, free up $3,800 a month. By the way, their income, it wasn't like they're broke. Their income was almost $60,000 a month, but they just had all these different little loans and things like that. They had gone from car loans and a few credit cards and whatnot. It's like, hey, we just consolidate, free up $3,800 a month. That's 45 grand a year. Send them to a CPA because you got to look at those taxes. They were overpaying by over 30,000 a year. So we found more money there. And then this rental they had 200,000 equity, but no cash flow. So we sold that. Even before they tried to invest $1, they were already improving their cash flow by 100,000 a year. You take that 5 million, they're not going to invest all 5 million. They took a few million, but take that 5 million, that would be 500,000 a year at 10%. That's 600,000 a year. Their goal was roughly about 23,000 a month. We could easily beat that. So here, this person, now some people are like, I don't have millions. Great, 250,000 invests. This person bought 6 rentals, created 30,000 passive income. But 6 years later, he was on my podcast again. 6 years later, it turned into 40,000 of passive income. Plus, he had 650,000 equity, which he could even cash out if he wanted to and invest that to even bump that cash flow. And his goal was just 5,000 a month. So he's literally just a year or two away from financial freedom himself in his 50s. That's what it means to become work optional. So So this is the big thing, guys, is you want to get your money working harder than you without having to gamble or just hope that it works out. Hope is not a financial strategy. Hope is not something you should do. We're not smoking hopium here. We want to make sure it works right. Tell you about the story with my dad. This is a picture of my dad, the last picture we got with him before he passed away. He just passed away last month, 81 years old. Like I said, he lived way longer than he thought, especially considering he was a smoker for 50 years, diabetic. He had 14 stents put in his arteries and broke all of his hips 5 years ago and somehow made it to 81. But literally, I had to come in and start funding him. I had to start paying for his caregivers, $13,000 a month for his caregivers because he refused to leave his house. And he couldn't leave his house for that matter. He needed 24/7 care. And that's the difference, guys. Like he was literally spending every little dollar, trying to stretch every dollar he could, trying not to live life the way that he wanted to. I'm grateful I had the means to do so. And that's the thing is that I don't want you to end up that way. Don't be the person that should have been the poster child for Dave Ramsey of the perfect role model, only to find out that he was retiring broker than he wanted. And again, he had hundreds of thousands in savings, but that money doesn't last long, especially when you're pulling that money out. And of course, on top of that, rising costs and everything else you have to battle, even with the Social Security and VA benefits, guys, it just wasn't enough when he lived longer than he expected. That's the problem. That's what I'm fighting against. That's why I talk about the sign, live life now, not tomorrow. You need to create freedom today. We don't know how much longer time we have. By the way, that guy that created 130,000 a year, just so you know, last year he passed away, 64 years old, had a heart attack at his desk. He had 4 years he was financially free. What if he would have followed his financial advisor's advice? What if he would have said, 30,000 a year on my millions is just not enough. Maybe I just got to keep working. Guys, he not only was able to do what he wanted and live life on his own terms, he actually started volunteering for the Forest Service in California. He actually went and attended different investment conferences and even brought his sons with him to pass on the legacy of knowledge that he was learning. He was able to do that because he had the freedom to do so. Cash flow is what creates options in your life, and options is what creates freedom. Guys, here's the difference. Here's the thing. You can sit here all day long and learn this stuff and say, this is great, love it. But even if you're on the right track, you'll get run over if you just sit there, as Will Rogers says. You got to take action. So here's a QR code. If you guys want a free consult, especially on that max ROI infinite banking, you can scan that QR code right here. It should take you right there. I don't remember what the link is. Somebody maybe could post that in the comments to say, here's the link if you click on it and it works. Because I know I'm tech idiot, so I don't know how to make that work. Great way to get a consult to at least see that first step of how can I use that max ROI to protect my assets, play offense and defense at the same time. That's a very critical component. Some people have asked me about the work optional calculator we have on our website at moneyripples.com. You can also use that to see how much passive income is available that you can actually create in the next 12 months. So that's definitely something you could check out too. So anyways, I'm going to stop sharing at this point. Make sure, actually, I'll leave it up here for just a bit for you guys to scan if you want to.
Chris,
I'm gonna hit questions.
Awesome job. Thank you so much. I actually just put that in the chat screen, so it is clickable.
Oh, good.
So if you do want to sign up for a consult, it's a free consult. Chris, I did put that in the chat. Click it there. I've seen the page. It's beautiful. It's very easy. Sign up. Chris, so what happens when they click that link? They just sign up for consult, and what happens?
Yeah, so it sets up a time just to see one if it's even a good fit. That's the biggest thing. We don't want to just, like I said, it's not for everybody, but definitely it's a good fit. Answer any questions to see if it would be a strategy that works for you. If not, we probably have some other options or things that we can possibly recommend depending on your stage. Like I said, for infinite banking, if you're paycheck to paycheck, like if you're literally like you cannot rub two nickels together, it's probably not the best thing for you. I did forget to put in a slide that if you have a lump sum of cash, you say, I want to keep this money safe and generate income off of it. There are ways to do that too. And it's pretty cool to create some ways to create some tax-free income. So anyways, that's a different topic right there. But again, you can just book that quick conversation just to see if it's a fit, see if you want to see numbers and things like that. I love the fact, I forgot, I made it simple. moneyripples.com/protect wealth. That makes sense,
it's beautiful.
doesn't it? Yeah. So there you go.
Yeah, guys.
And like I said, I know some people are like, hey, I've already got infinite banking working. I know there's been comments about that before. That's true. If you're looking more for passive income on the website, moneyripples.com, again, if you go to that, you can also see there's a work optional calculator. that you can try out and see just what your number is, like what could be possible in the next 12 months.
You guys, you can see why we brought Chris on. The guy knows so much about this. My favorite part about this is, Chris, you're giving examples, real world examples that probably
Mhm.
fit a lot of our students here, their profiles. It really does help open my eyes. I love this. It shows exactly what you can do to broaden, hopefully, your passive income primarily. That's the biggest thing. I love that. That's what we're all about here, is protecting the assets and building the assets. And this is a great strategy. We work with a lot of high net worth individuals, and this is something that they do very frequently. This strategy. It's not well known, obviously. That's why I brought Chris here. So thank you so much. Definitely click on that link. We're excited to have it.
Yeah.
Oh, yeah. We do have questions in the chat screen. Yeah, yeah. We're planning on getting to those. Okay, Chris, there's several questions. Are you okay to jump in on those?
Yeah, let's do that. Let's see. Yeah, I know the audio cut in and out sounds like a little bit here. And hopefully there's gonna be a recording of this. I'm pretty sure anybody who signed up for
Yeah,
this gets the recording later, right?
correct.
Okay. So yeah, I want to get to that question for Tom. It says 79 years old, hold a mortgage on 3 houses, getting 6.5% on 600,000. Also invested with Eckerd. Awesome. 1.6 with Fidelity plus Social Security. Looking for legacy for grand and great grandkids. Have any suggestions? Um, Possibly, yes. I think the best thing to do, book that call for certain. There's definitely a lot of parts there moving that we would want to look at for sure. One would be your own personal cash flow. Like, how are you doing now? If you feel like I feel completely comfortable, I did have a guy that came to me. He said it was unique, not common. He said, Chris, I'm already making over 200,000 a year passive income. I'm good, but I want to make sure that my son, who's in his mid 20s, I want to make sure he knows how to do this. And I said, okay, that's perfect. Well, what about your wife? Oh, she doesn't know anything about this either. Okay, who's likely to die first? Probably me. Okay, cool. He's like, yeah, so I'm going to put my estate plan that they should hire you when I die. Great. When do you die? I don't know. Me neither. Should you wait till they're emotionally dealing with all this crap and then they learn about it, or should they learn about it first? I said, good point. Maybe we should actually work together sooner. And I said, yeah, if you're looking to invest, what better way than when you have money coming in, we can show them how you go and invest it and how we can create that pattern. So you can create not just trust fund babies, so to speak, but you can have this money creating wealth generation after generation after generation. And yes, to Tom's point, even not just that, but even like could we be using like infinite banking with our grandkids or our great grandkids too, and creating almost like a legacy plan, just like the Rockefellers and the Rothschilds have been using themselves, that have been able to pass down wealth for many generations, as opposed to I'm trying to remember I'm blanking on his name, Anderson Cooper, his family,
Yeah.
the Vanderbilts, where
Yeah.
they lost their money. They did not pass on from generation to generation because they did not, one, teach the kids how to do this kind of stuff with investing, and then two, how to use this life insurance strategy to keep that money going again and again.
So cool. All
Let's
right, yeah.
see.
And Chris, by the
Yeah.
way, there are some questions in the Q&A section as well too. So, uh,
Oh,
and I can ask those if you'd like me to, if you don't see those.
sure. Yeah. Kitan says, what are some insurance carriers you work with, or that this does work with? I showed some examples of Penn Mutual. They're great. Mass Mutual can do good too. But like I showed you before, just because you use that insurance carrier, the likelihood is the insurance agent will do a crappy job of it. So be careful. But yeah, mutual companies are typically what we look for. Guardian is another one they can use too, and things like that. Um, so yeah,
Yeah,
that
you
kind of
want to be
thing.
careful. We've learned our lesson this way too. If you work with an insurance person that has their license and they don't know what they're doing, they can really mess this up. We've seen this over and over. So you want to work with someone like Chris.
Yep. All right. So moving on to so I know to get the slides, you get the recording. I'm sure that's all. I can make sure you get the slides too, so they have that as well.
Thank you.
Mark asks, where does precious metals fall into the spectrum of assets to protect one's wealth? Well, as you mentioned, I love them. I happen to have some sitting on my desk right here. I won't tell you the address because, I don't want you guys stealing what's this, roughly 170, 180 bucks. But anyways, not that you would come over for that. We can just have dinner. But no, spectrum for assets for metals, definitely a big favor of it. I refer to it as Fed insurance. When the Feds decide to print more money, I'm glad I have assets like that. This is better. It's kind of like the next level phase first level, the first thing you're trying to get to, the first goal you're trying to accomplish is becoming work optional. That should be the focus, even over trying to buy a whole bunch of metals and whatnot. Get yourself to the point where you have enough investment income coming in to pay for your bills, and ideally even more than that. I think work optional is like the bare minimum. That's financial independence to pay your bills. Financial freedom is the next level up. As you get into more financial freedom, then we start looking at diversifying and going into a lot of different assets. And that's where metals, you might start doing a larger percentage than what you've done in the past. So metals, big. I love to diversify among metals, commodities. That's why I have mineral rights and oil and gas, right? I've also got, things like paper assets. That's where life insurance falls in. Don't really have much in the way of mutual funds anymore. I've sold those off already. But real estate is a big one, and then business is the other. That's the fourth asset. I do have a little bit of digital if you're to throw a fifth asset in there, but I'm not a huge fan of trusting Bitcoin. It's just a little too young and temperamental for me yet at this point, but I have a little bit of it just for fun. Let's see. Ellie says, "What's the reason this young man put in 10,000 the first year? He can get about 6,000 the first year, while the other lady who put in 30,000 only gets zero for the first 2 years." So I know he's referring to Ellie's talking about the two examples I gave. The reason that this guy was putting in 10,000 was because that's what he could afford, right? So it's just cash flow is the main thing. Her situation, she was a neurosurgeon making about $750,000 a year, so she was putting in 60,000 a year. So that's why she was putting in 60, right? That's less than 10% of what she could put away. But yeah, he got about 6,000 that one, but he could have done much better. So the whole point is definitely the reason. Oh, I think I know what she's saying. The reason why they're different, why the one woman only got zero for the first 2 years, and then he had 6,000, is because he actually was using somebody who did know about the blending, the pulling those levers to make it cheaper, where the other agent was just a typical insurance agent, didn't even know he could do that. The problem is that I get a lot of people that say, "Oh yeah, I already do this infinite banking thing." And in fact, yeah, I have more than zero in that first year. Like I have, like in this guy's case, he's like, "I'm going to have $7,000 after putting in 10." And I told him, I said, "Well, what if you could get 8?" He's like, "Oh, I don't think he could beat it." I'm like, "Watch me." And we did. And it blew his mind. He became a raving fan because of that. So that's the thing, is that most insurance companies and insurance agents will tell you how to do the traditional whole life. And that's the thing that Dave Ramsey poo-poos all over. And Dave's totally justified in doing so, because I believe that is a ripoff. But there are ways to, again, pull levers to make it better. We often do that by minimizing the death benefit a little bit more, and that allows more costs or less costs to come out. Greg asked a good question, because I didn't mention this. Is the interest paid to the insurance company tax deductible? The answer is depends. So if you're using it for business expenses, for business purposes, then yes. Just like if you were to use a credit card for a business expense and you get a tax deduction on the interest you pay on the credit card, same thing applies to life insurance. But normally, no. If you just use it for any other purpose, that's not a business type of anything that you normally write off anyways for interest, then no, you can't write that off as interest. I do tell people, if you're a business owner, it's like a triple dip, because not only you're able to, make the spread of making more income than what you pay on the interest, right? And you're investing it, but then you're also writing off the interest anyways. So it's pretty cool.
Very cool strategy. I appreciate that very much, Chris. Again, I put that link back in there again. I had a few more people asking about it. And we'll make sure that's available. And the recording will go out tomorrow. And Chris, yeah, I guess people are asking for your slide deck. So if you want, I can include that in the email tomorrow if you'd like. Totally up to you.
Perfect. I'll do it.
Thank you so much, Chris. We really appreciate it. Great strategies. One of the sayings I love is, if you do what everybody else does, you get what everybody else gets. And so we see that over and over, especially this. You have to have, someone like you, Chris, and your team that knows what they're doing to do this right. It's not just about, like you said, spaghetti on the wall investing. It's about doing it the right way, consistently over time. And I love that. This encompasses everything that we teach. So thank you so much, Chris.
Yeah, thank you for having me.
Okay, well, we'll go ahead and put that in the chat, or the link tomorrow, guys. Thank you so much for your time, Chris. Always good to see you. We will send this out tomorrow, everybody. Again, Chris, appreciate you being on.
Thank you.
Everybody, have a great night. Thanks for being on.